Welcome to the Business Standard Banking Show. IDFC First Bank reported a strong profit growth in the fourth quarter recently. The profit grew by 168% to about 342 crore. To speak more about the bank's strategies and plans going ahead, we have Mr. Vaidyanathan, MD and CEO of IDFC First Bank. Mr. Vaidyanathan, welcome to the show. First, to talk about while announcing the Q4 results on Saturday, the bank has said that in the first 3 years, the bank tried to increase its retail deposit base while slowing down on loan growth. Now, yes, now the bank is set to take off the loan growth and planning a loan growth of 20 to 25% over the next 3 years. What could be your strategy on the loan growth? Which are the sectors this loan growth will come from? Since you are already said that since the bank's focus is to be a retail-focused bank.
See, currently our loan book composition is as follows. Our 38% of our loan book today is basically either home loans or loan against property, which is basically property covered. Consumer loans is 18%, vehicles is 12%, and SME loans is 12%. We feel that, so this is the broad breakup of our retail book to your question. Now, we feel that each of these businesses, whether it's consumer loans or wheels or SME or home loans or loan against property, everything will grow in this country. So really for us to grow 20-25% on home loans or other businesses is really no problem at all. In fact, we'll be launching new businesses also during the next 2 or 3 years.
Which are the new business you plan to enter in the next 2 to 3 years?
We just launched our gold loan business. We see a really big potential because we have a large number of branches now. So gold loans can be given from our branches. We expect strong growth there. The other business we are launching is we are scaling up, let me say, is the wealth management business. We want to scale up our commercial vehicle business. It gives us priority sector requirements also. We want to scale up really many. We are doing very well in the cash management business. We're doing extremely well in the fast tag business. Our regular businesses also, these home loans and car loans, everything will scale.
In December 2018, when Capital First merged with IDFC Bank, you said that the medium-term roadmap, that is over 5 years, you will increase your retail loan book to 70%. Have you already achieved the journey, achieved the target?
The way we are looking at it right now is that we have launched so many businesses, the vehicles business, car loans business, home loan business, loan against property, so many of them. The way we're thinking is that none of the businesses for the bank should exceed 15%, except home loans and loan against property, where we want to, where we have kept the upper cap at 20%. So, and of course, corporate. So basically, we want to be a very, very diversified bank.
Also, one of the very interesting thing which came out from your fourth quarter result is that your CASA has now reached almost 50%. Do you think this kind of high CASA is sustainable going ahead?
See, last year our CASA grew very strongly. From in FY21, our average CASA during the year was about 42%. During FY21, during FY22, our average CASA rate was close to 50%. So that's a very strong growth. We feel that this will definitely be sustained by us, or probably even grown between 23, 24, and 25. We want to be a 50% CASA bank, and we have a strong inflow of deposits on savings account and current accounts in the bank.
Linked to CASA is your net interest margin. The net interest margin for the financial year 2022 was about 5.96%. That's one of the highest among Indian banks, I think. Again, do you think that kind of margins are sustainable? You can hold on to those margins?
Our main reason for the NIM expanding so much is that our CASA percentage increased. Because earlier, these monies were from a wholesale deposits, or they were from legacy borrowings, which was at 8.8%. Now we are repricing the same 8.8% to as low as 4.8%. So that amount is straight away coming through the net interest margin line. So the main reason is that. The number two reason is that last year cost of funds also came down quite sharply. So that also is resulted in a big improvement in net interest margin. So we feel that our business is well structured, and for us, this kind of net interest margin permits us to make the necessary investments in building the bank for the future.
Again, in December 2018, when this merger took place, you talked about a cost income ratio of reaching 55%, which was 80% at that point in time. I think as of last quarter, the cost income ratio is somewhere around 76%. So, I mean, do you think you will be able to achieve the cost income ratio of 55% by the end of the 5-year period from merger?
See, that's how whenever any business is set up, that's how cost income behaves. Because in the initial stage, when you set up a bank, there is very little income, but you are setting up branches, ATMs, all the people, everything comes. In fact, pre-merger, for the half year of FY 19, pre-merger half year, the cost income ratio of the bank was 92%. Now, after that, every year it's been coming down. Last year it was 83, 84%. This year it's come down to 70, mid 70s. Next year it will come down further. So cost income ratio will keep coming down for the bank. There are three reasons why cost income was high. For example, we even today. Let me say there are three reasons why cost income will further come down. And these are as follows. Today also, we have 25,000 crores of legacy borrowings, which we were paying 8.7% today. When we replace them with the current cost of money, about 4% lesser, that will straight away add to the income line. So the cost to income will get better. The other reason is credit card business. In the credit card business, we have high cost income in excess of 130, 140%. But we are very sure credit card will become profitable, and that will straight away reduce the cost income in the next 3 years. And third is also that set up a branch, etc., will start selling many other products from the branches. So we are very confident there is a glide path, cost income will come down in the bank.
In the last 4 quarters, we have seen improvement in asset quality, both in terms of net NPA and gross NPA. But now, as the RBI's the one-time restructuring scheme, which was announced during COVID period, will come down, will come to an end by, say, September, October. How do you think the asset quality will shape up?
When we look at asset quality, there are 3 or 4 things to look at. One is gross NPA. Our gross NPA has already come down from 4.01% in March 2021 to 2.63% as of March 2022 on the retail side. That's a big drop. On the net NPA front, again, it has come down from 1.9% as of March 21, 31st March 21, to it has come down to 1.1% as of 31st March 2022. Our SMA, which is the pre-NPA stage, 1 to 90 days overdue, that bucket is also shrinking quite sharply for us. The fourth thing is slippage. Again, on that front, the retail slippages are coming down every quarter. Number 5 is recoveries. Again, recoveries are increasing since the last 4 quarters at a stretch. So every indicator we are seeing, we are finding that the asset quality is getting better and better. So we feel that next year our retail NPA should come down to below 2% gross, and net NPA of retail should come down to below 1%, maybe about 0.7% or 0.8%. So this trend is very clear for the bank. I believe that our bank is set for a very solid performance over the next few years. Very simple reason that the first 3 years we were not growing the loan book much because we had liability side challenges to address. But that is all sorted. Our biggest thing that you should now in the bank, we have addressed the asset side issues, we have addressed liability side issues, we have addressed everything. Only one thing we have to grow is profitability. And this year onwards, you will begin to see the profits rise. Last year, our operating profit grew by 44%. We expect that next year as well, and the year after that, we believe that sort of track can be maintained. You can watch the results to get more confidence.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.